Hello everyone, this is the quick tutorial for single index models and CAPM models and how to estimate the coefficients of these models in Excel using the data analysis add-in. Before you proceed, make sure that you have data analysis installed in the computer with the Excels. To check this quickly, you can go into the options for the Excel, add-ins, manage add-ins, click go, and make sure you have a tick mark next to the analysis toolpack. Once you do that, the data analysis will appear under the data tab in the Excel ribbon with the data analysis. In this example, I have prepared the data. The actual data that I had spans from 2008, January 1st, all the way to 4th of March 2014. Now, to do the regression and to estimate the coefficients, I'm only going to use the partial or subsample of the data set. The reason for that is years 2008, 2009, and partially 2010 are plagued with high volatility and the consequences of the global financial crisis. In my opinion, this high volatility is not consistent with normal market returns and the behavior of the market in the more recent years or the years going forward. So I'm going to use the data in my example only starting from the beginning of 2011. So to show you the example how this is performed, I would go to data analysis and I will look for regression. Click on the regression, and the user interface for the regression analysis asks you for several inputs. First, it asks you for the Y range and for the X range. If you recall the single index models or the CAPM, the Y range, the dependent variable, is your stock return, a single stock return or a portfolio return. Your X variable is the independent variable, which is the market index returns. So in order to perform the regression, I'm gonna select the Y range, and let's select the fourth stock, the ATCO company. These are my returns for this particular stock. So I've selected those. Now my X range is going to be the market index. You can either select them the same way as I did for variable Y, or copy the reference and change the column that your reference is to the market. And my market is in column K. Now if you look above, you will see that the range that I've selected contains the labels for the returns that I've picked. For example, K2 is S&P TSX index, and O2 is the name of the company returns that I've selected. So if you did select the labels, you have to make sure that the labels is checked in the regression dialog box. Now the output can be output from the regression can be inserted in the same current sheet in a specific range that you select, or it can be outputted in a new sheet in the same Excel file. So I'm going to select the output range to be inserted right next to the data that I have. You have additional options, for example, residuals. You can output the vector of residuals or the vector standardized residuals, or you can plot your residuals to see if there are any particular patterns, or you can simply see how the line, the regression line, fits the data that you have available. All of this can be checked here as an option if you want to explore further. If not, you can simply click OK, and your output will be where you desire it to be. So the coefficients of interest is our adjusted R squared, our beta estimate, its significance, our intercept, and its significance as well. So how to interpret these results? Well, adjusted R-square tells you how well the returns on the stock are explained by the fluctuations in the market returns. It turns out that we were able to explain about 18% of the return fluctuations in the ATCO stock with the returns in the market. The beta estimated is 0.62, and this beta is significant. The number represented here is in scientific format, so it's best to convert it to a normal decimal representation. So essentially the p-value for this estimate is 0, which means that the beta estimated in the amount of 0.62 is significant. This beta is representative of a defensive stock, as it's less than 1 and reacts less to the market fluctuations than stocks, for example, with the beta in excess of 1. The intercept turns out to be insignificant and can be ignored and assumed to be 0. We can try another stock and see how the results are different. So we go back to the regression. We keep everything the same except for the Y range. So instead of looking at the stock in column O, which is ATCO, we can look at the BCE in column P. So I'm just simply going to change the reference to the P column. And not to rewrite the output that I already have, I'm going to select the start of the output from cell S21. Click OK. Now, below, I will have the output for the BCE stock. The R-squared had reduced, so the explanatory power or the goodness of fit of this particular model is lower than before. We're only able to explain 14% of fluctuations in the BCE stock returns with those of the market index. The beta is even more defensive. It's less reactive to market fluctuations. The beta equals to 0.32. The beta is significant if you look at the number with a few decimal points. Essentially it's 0. Now what's interesting about the BCE stock is that its alpha or the intercept is actually significant. This normally would rarely happen for the individual stocks. More frequently you would observe this when you perform the same regression analysis for the portfolio stocks. But essentially what it says is that BCE stock is consistently outperforming the market index by this amount on every day. You can annualize this intercept to get the outperformance in terms of annualized returns. So these are the results of our single index model. CAPM model is very similar to the single index model. The only difference is the way that CAPM equation is defined. If you recall, the CAPM equation is defined as your excess stock returns on the left-hand side of the equation with excess market returns on the right side of the equation. So in the next tab here, I will have to define my excess returns in addition to just the returns. In order to be able to define the excess returns, I will have to have the data on the risk-free rate. The risk-free rate changes not as frequently as the prices for the stocks or the market index. Nevertheless, you should be able to download the daily data on your risk-free rate proxy. There are several options that you can use to get the risk-free rate proxy. These could be the overnight cash rate, that could be 1 month or 3 month T-bill rates. So in this particular example, I downloaded the data for the overnight rates, and I downloaded the data for the 1 month T-bill rates, both of which can be used quite effectively to get the proxy for the risk-free rate. Now here is the prices for 5 of my stocks as well as the market index. Now the returns are found in regular fashion, so simply these are just the difference in logs of the prices or the log of the ratio of the prices. This is for the market, and this is for the stocks. These would represent the daily returns for the stocks and the market index. Now, in order to be consistent with our daily data or the daily returns for the stocks and the market index, we have to convert the risk-free rate in its daily representation. Now, if you notice on the data that the risk-free rate represented as percentages and represented in the annual form. So, for example, these 5%. How do we convert it to the daily data? Well, first of all, we have to divide it by 100 to make the percentages into the decimal points. And the second thing is we will divide it by the 365. If you recall that we use the annualization factor for the daily data, we use the 250. 250 is representative of the number of trading days on the stock exchange of any particular market. However, for the risk-free rate, it's independent of whether it's a weekday or whether it's a weekend. You still get the interest on a daily basis. So in order to convert it to a daily representation, we have to divide by the full number of days in a calendar year, which is normally would be 365. So once we obtained the risk-free rate on a daily basis, we can now define the excess returns. Our excess returns are simply the returns on the market index minus the risk-free rate, and the excess returns on the stocks are simply the stock returns minus the risk-free rate, and this is performed for every single stock in our data set. So now we have the returns and we have the excess returns, and we can directly compare the single index model with the CAPM model and see how the results are actually different. So we do the regression, and let's stick with the ATCO company, which is the stock number 4. We go into the regression. We define the input range. Now, the input range I will use will only span from the beginning of 2011 to the end of the 2012. Now, if you refer to the data, the original data that I have, this is actually quite a big data set starting from 1999 and finishing in 2013. The year that I'm looking for is 2011. This is post GFC, and this is actually the ones that I want to concentrate on. So 2011, the beginning of 2011 starts at the row number 3135, and December 31st, 2012 is the row number 3655. So I will use these references when I refer to my data in the regression analysis user interface. So click on the regression. Now my Y range, let's do the single index models first. My Y range would be the stock return, and we said we're going to take the stock 4, so this is the column R, and I'm going to be using the data starting from the row 3135 and going all the way to 3655, which is December 31st, 2012. My X range will be my market index, which is exactly the same reference, except my column is going to be column N for the market returns. Now, the other thing that I have to make sure that the labels are unchecked, because I select the data range within the data set and it does not contain any labels. So I have to click off the labels options in this particular example. The output range will be right next to my data. I'm going to output it here and click OK. So again, you can see that adjusted R square is 19%. We are able to explain 19% of fluctuations in the stock returns with the market. My beta is almost 0.6, and it's quite significant. The intercept is insignificant, and the p-values for it is 0.15. That's why it's insignificant. Now I'm going to perform exactly the same analysis, but I'm going to use the excess returns. So my excess returns for stock number 4 are contained in column Y, and my excess returns for the market are contained in column U. The output range for this regression will be just below the one that we used before. I get almost identical R squared, I get almost identical beta, it's significant. The intercept is a bit different, it's still insignificant. So as you can see, the model gives you almost identical results. The only thing changes is the interpretation of the intercept coefficient. It is now exclusive of any risk-free rate fluctuations, and interpretation of this intercept will be exact interpretation of Jensen's alpha. You have an option to either do the single index model regression or do the CAPM regression for the purpose of your problem sets.